Hello students, good morning. So today in this class we will be proceeding for the insurance and assurance part and also the types of insurance. Okay, so till the last class we have discussed about the various principles of insurance, right? I suppose you remember this. See, these principles of insurance will be very necessary at a time when we discuss about the different types of insurance. Okay, so in there we will be learning what are the principles applied and what are the principles that are usually rejected in the various types of insurance. Okay, so before this let us discuss about the difference between insurance and assurance. Okay, usually the fire insurance and some marine insurance, all these things will be included under your this insurance part, and the assurance, that is the life of a person, insurance of the life of a person, where the compensation needs to pay without the happening of an event. That thing will be discussed under your assurance part. Okay, see here in insurance, the insured must suffer a loss to claim compensation. That means in insurance the happening of the event must occur. Okay, then only if the happening of the event will not occur, then the insured will not get any compensation. Just like for example here you see in your car insurance or in your fire insurance, the happening of the event must be occurred, the accident must be occurred, then only you will be getting compensation. But the case is not that with your life insurance. In the cases with your life insurance, whether you take the policy, whether the accident occurs or not, whether any happen occurs or not, you will be getting the amount that you have paid to the life insurance company after a particular period of time. Okay, along with bonus. So that is actually the difference between insurance and assurance. Okay, another important thing is here you see the concept of pure risk. Pure risk here it will be applied in the cases of insurance. Pure risk means what? There can be loss or there can be no loss. Okay, if there is no loss, then you will not be getting any compensation, but if there is a loss, you will be getting compensation. That is the concept of pure risk. Okay, and another thing is that your speculative risk. There are usually two types of risks. Number one is your pure and number two is your speculative risk. Speculative risk will be determined under your assurance. Okay, that means there is a chances of getting profit or there is a chances of getting loss. Okay, that means if profit that means what? Whatever amount you have deposited there, you will be getting back the amount along with the particular bonus. And loss, how losses can be occurred here you see, if one accident has occurred, there are some insurance companies whose very rarely they give the entire amount of spendings that you have done in your medical, but there are usually most of the insurance companies which does not give the entire value of your hospital bills. They only give either a part of it, either 50% or 75% of it. That is, the rest is your loss. Okay. So I can suppose that you can understand the difference between the meaning of pure risk and also the speculative risk. In the pure risk, there is no concept of profit. There can be either a loss or no loss. That is the meaning of pure risk. And in the cases with your speculative risks, that can be either your profit or can be either your loss. Okay, I suppose this is clear to you. Come to the next slide. Here we will be discussing about the various types of insurance. Very important from your examination point of view. See, after that discussing about the various types of insurance, the postal and communication services, that will not be included for your half-yearly syllabus. Okay, so that is the portion I am skipping it for now. So after completing the various types of insurance and also after discussing about the various principles of insurance related to this, we will be again revising this chapter and then we will be proceeding for the next chapter. Okay, now come let us discuss about the various types of insurance. Number one is your life insurance. Life insurance, already you know, it is the concept of assurance related. That means assurance on the life of a person, right? If a person suffers any accident, he will be getting compensation for this. Okay, and if he does not faces any compensation, then he will be getting the reward or the bonus of the amount that he had deposited in a particular insurance company, right? Next is your fire insurance. Fire insurance are those that are related only to the cause of fire. That can be done for a factory, that can be done in any organization other than the life of a person. Okay, next you see marine insurance. This marine insurance are those insurance which are done usually in the cases with your sea perils to give a protection against the sea perils. Okay, that means the various destruction of the sea or that are caused by either due to piracy or either due to storm or any other natural calamities which are not in the focus of a person. And the last one is your health insurance. Here we will be discussing about the different types of health insurance that are available for the life of a person. Okay, let us see one by one. This life insurance. See, life insurance is related to the uncertainties related to the life of a person. There can be very uncertainties, not only these two. There can be very uncertainties even in the course of your movement. You may face uncertainties, but the primary objective is this one. That is risk of dying too late or the risk of dying too early. You see, in that cases with risk of dying too early, it means that when a person dies very early, then who will be feeding his family? So that can be considered as an uncertainty. So in order to protect that uncertainty, the persons will be taking an insurance policy. Okay, next you see, dying too late. That means if a person has lives more than the amount that he will be able to work for himself, then he may faces some problems relating to his old ages. Okay, he may face some problems relating to feeding his own basic necessities. So in that cases, person usually prefer life insurance policies. Okay, see here, it can be for the whole life. That means the entire period of life. How many years he lives? It can be for entire period of time, or it can be a part of the life. That means it can be only for 20 years. It can be up to the age of 30 years. Or it can be up to the age of 60 years. That depends upon the terms and conditions of the policy. That is policy, that means a written agreement between the insurer and the insured. Okay. And next one is that how will the LIC or any other life insurance company determine the value of premium? So premium is determined on the basis of two factors, that is number one mortality and number two is your morbidity. Mortality, that means how many years a person will be living in a particular area. What is the life expectancy ratio of a particular country or a particular area. That the life insurance company usually determines that. And next one is your morbidity. See, these are actually some cases of speculation. That means a person cannot, a company cannot determine how a person how many years a person will be living without any illnesses, right? So these are some certain cases of speculation that determines that is determined through statistics, but it is not a clear-cut meaning, or the company or any other insurance companies will not be getting a clear picture of how many years a person is going to live without any cases of illnesses or morbidity. Okay. Next, come to another slide. Here you see the elements of life insurance company. See, in the cases whenever you take a policy, what could be the common elements will be present in that policy? Here you see utmost good faith. That means both the insurer and the insured must have a faith in each other. They should not be trying to deceive each other. All these things we have discussed in our principles of insurance. In that cases with utmost good faith, that means what if a insured has got a particular illness which is trying to conceive from the insurer, then after a particular period of time the insurer detects that this particular person was suffering from a particular illness during the time when he was doing the policy, then the insurance company will not be giving any compensation to the insured. Okay, that is point number one. Next you see insurable interest. That means to whomever I am taking a particular insurance, I must have that interest on that. If I am taking if I am taking an insurance policy of my own relative, the insurance company must also know that relative. Okay, and then they must be having an insurable interest. That means both the parties must be having a particular interest on the insurance project or in the insurance object that they are they are able to do it. Why I am telling you insurance object? Because that can be either a person or that can be either a house. For example, if you go to a bank to take a loan, then the bank manager will be asking you for mortgages. You can show the mortgages of your factory, but after a particular time the factory is destroyed by the fire, then the bank manager will be asking for to avert such a policy, to avert such a possible destruction. The bank manager will be asking for fire insurance on the mortgage value that you will be showing to him at the time of taking the loan. Okay, next you see I cannot take an interest, I cannot take an insurance on any of my dog or any of my unknown person which is not known even to me or which is not known even to the insurance company. Both me and the insurance company must know the person or the object for which I am taking an insurance. Okay, that is the concept of insurable interest. Next you see this life insurance does not include these following principles. Why it does not include this following principle? Here you see, number one is the principle of indemnity. That means if a person dies, for example, if a person of a very economic background, he dies, what is actually the value of that person? Or if another hand, if a rich person dies, what is the value of that person? We will not be able to determine. No person in the world will ever be able to determine the value of any person. Either he is rich or poor. Okay. Next you see, principle of contribution. Principles of contribution, what was that? See, all these things we have learned. So I have told you in the beginning of my class to be very clear with the principles of insurances. Okay. So under the principle of contribution, what is that? If I have taken a particular insurance from Tata, if I have taken a particular insurance from Birla, so in an events of loss, then I can claim compensation from all, from Tata, from Reliance, everyone. Right? That is available in the cases of your life insurance. That is actually an exception to the life insurances. Okay. But in the cases with company, the cases with company is not that I will be claiming compensation separately from Reliance, separately from Tata, separately from Birla. All these things are not available for any other organization other than the life of a person. Okay. In the cases with the life of a person, I can claim compensation from everyone. But in the cases of a company, they cannot claim compensation separately from all the insurance companies. Right? Next you see the principle of subrogation. That means principle of subrogation means what? What if a particular insurance company has compensated for the loss, then the entire value of that property goes on to the hands of the insurance company. That means if the insurance company sells all the scrap value or the leftover elements of that property, then the whatever money they will be getting, the insurance company will be taking away that money without giving to the beneficial owner of that company or beneficial owner of that factory or any other property. Okay. So these are some of the exceptions to the life insurance company.